go.
We're in the beginnings of the credit cycle rolling over. We're just waiting for the stock market to figure that out. The other thing people should understand is semiconductors, which are a big feeder into the AI investment, the CapEx bill, are so far above their monthly Bollinger Band. The only last time they did this was in March of 2000. So it feels to me like these are ending moves. And then they'll start discounting weaker fundamentals soon enough. We've seen this before. I mean, in this most recent rally, after the war scares and then Trump, announcing ceasefires, the market had a tremendous, unprecedented move led by AI and semiconductors. What's interesting is the Dow Jones Industrials have not confirmed this move. They've not gone to a new all-time high.
Mama.
In fact, they're starting to, they peaked out a couple days ago, and it looks like that's having a hard time advancing. We're also, I should also remind people, even though we're up new all-time highs, we're only 3.6% above the all-time high put into the S&P 500 in October, and I think my number 2.4% above the January high. So, it's been a lot of work to get to these highs, and it's all concentrated in one sector. You know how that ends. And with the economic backdrop and the fundamentals, you're basically picking up pennies in front of a steamroller, in my humble opinion.
Hey everyone, my name's Anthony Fatsis, and welcome to another episode of the What the Finance podcast. On this episode of the podcast, I have the pleasure of...
All right, you got a good accent. All right. Railtown, you now own 19,865,184 shares. Put it another way, we are fewer than 150,000 shares from 20 million. You guys are amazing. I'm not going to erase that. I'll show it again. I'm going to try to do a bunch of things today. Let me just, I'll remember them as I go. Okay, let's see where we are. Buckeye in Puerto Rico. Hello, Bill and RT crew. Hola. Pat M. All right, you guys. I forgot about that. I don't say that anymore. Well, all right, you guys. A young girl like you needs to marry a broker. They're going to make a lot of money. CJ Yukon, I picked up 8,000 at 31. Wow. I hope that other gentleman I got to remember who it was. Wow. He's so lucky to be able to do this because he doesn't have the burnout a lot of us have. He can come in, he can sell his other stocks, come in and buy Railtown, and it's all brand new to him in terms of ownership. For many of us, we've been in it almost a year. So we have our psychology going against us. I just forgot his name. I have a Joe Biden brain, I tell you. I'm starting to scare me. It is starting to scare me. I'll think of it. Just not when I'm thinking of it. When I want to think of it, I won't think of it. When I'm not thinking of it, it'll pop in my head. But what an opportunity he has. What an opportunity. Underdown. Will Underdown. He's like the prodigal son. He comes back. The rest of us go, hey, Dad, how come he's getting everything? How come he gets the big party? We've been working hard. He's been out. But that's how it goes. That's how it goes. And if Will Underdown builds a large position, I'm going to be all for his becoming a major wealth creator. Okay, I'm trying to just get rid of old papers brutally, just throw them away. But I couldn't throw this one away. I'm going to after I go over it with you. But this is a paper I read to you in June of 24. So we're now in June of 26. It's from Von Greiritz Gold. Now, I haven't reread it, but before I throw it away, I want to get its value again to you. Yes, we're talking about Railtown, but we have to be ready to make. Look, I've made several assertions about this trade, and I stand by every one of them. But we don't know how it's going to play out. It is possible, for example, that, and please don't count on this, it's not a reason to own the stock, but it is possible there will be a short squeeze in this stock. I hate it because then you're going to be in the arms of the Tonys and the Franks and the Teds and the Freds and the whole crew of them, because you're going to be back to hot money. But maybe we can handle it if it happens. And I don't know what number to give you where I would just say, you know what, this is silly money, I've got to sell. But I think I just don't know. I don't think I would sell in the 20s. But would I sell in the 120s? It just depends on how it's going. And I'm not saying sell everything. Just pick a number on the margin, trade it. If it pulls back, try to buy it back. But I've told you the risks of that. That's one thing that could happen. Another thing that could happen is the stock could get bought out. Lickety splitting, like Tom Waits calls it. And if that happens, I would assume we'd be suddenly in a quote unquote blue chip stock. And I do think this gentleman, I don't know who he is. Every now and then I listen to him, but I don't know his name. There's a lot of negativity on the stock market right now that we're going to have a big crash. I may be being too fine by half, but I think that's the wall of worry that's going to, a lot of institutions and a lot of players are just not here for this next upside move. And yes, at any time, this secular bull market, 44 years of bull market, can end. But I think you're going to have that melt up beforehand. And that'll be our signal. But I could be wrong. It could happen out of the blue, like they often do. I've been reading this book, and this is a guy that has great fame on Wall Street, and I've followed him over the years, not closely. It's not like I ever met him or anything. But he points out that the only two lows in the stock market that made any difference to him, and he seems like he's about 10 years older, 15 years older than I am. I don't know. He's older. He said there's only two lows that he's seen in his career that mean anything. One was 1982, which is, I think, the beginning of the secular bull market. The other was in 2008. He said the rest of them don't matter. In other words, I'm using my own words. This bull market has been powerful for 40. What's the arithmetic? 44 years. That's pretty amazing. And so it can end at any time, or it can get stretched out. You know, there's no perfect way of knowing. I think our warning that the secular bull market is over is we have one last leg upward that's going to be a melt up. I think you could see, I read to you the other day that the S&P gave you 24%, 24%, and 16% over the last 3 years. It's at least conceivable you could get that much in 3 months, or some part of that in 3 months. It's going to be explosive, and I think that'll be our sign to lighten up. But anyway, if a so-called maybe blue chip technology company bought us, and we experience some of that, maybe we sell some, or maybe we at least buy puts, sell calls, buy puts, and we make a profit in our puts. We might use a little margin, but man, that's the one thing that'll kill us, is if we have margin balances. We want to survive this storm. We don't want to be wiped out by it. And you don't want to listen to the charmers. I mean, if you want to play with a little bit, play with a little bit. Once our stock is up. Look, the reason I get so adamant is this move from 35 cents to $7 is 20x. From $7 to 21 is another 3x. Now, I don't know how to do that arithmetic in my head, so let me quickly just do it on my loser calculator. That's 60x. So that's 3 times 20. That's pretty easy. So it's 60x. I think you can capture that. And then you can start making your own decisions. I mean, there's some people, I won't say who, unless he wants to tell you, but there are some views about Railtown, which I share. I just don't know how to express it, that this could be a multi-$100 a share stock, or even higher. I don't want you counting on that yet. That'll become self-evident in research reports, in contracts, in buzz. We don't have to think about that right now. I just don't want you to sell out with bumper sticker advice. Well, I think you should trade off. You should take your original money off the table. And what the hell? It is a speculative stock by nature, but this is not the Fed held interest rate steady. Wonder what that means. I think interest rates are very low, but I guess I don't know what their thinking is. All right, so one of the things we have to do in the future is we have to own gold and silver and the miners. But this is von Greiritz from 2 years ago, and I read it to you. The title is As Dominoes Fall, Gold Will Stand Stronger Than Crypto, I think, but who knows? It feels like there's a paragraph missing, but I don't have it. So it starts, but when things settle down, there will be offsetting forces such as the emergence of powerful BRICS nations backed by commodities, which I think we're going to be a commodity nation as well. Gold will play a major role during this process. Both central banks, sovereign wealth funds, and investors will turn to gold as the most stable part of the crumbling system. This will lead to a fundamental revaluation of gold. As more gold cannot be produced, increased demand can only be satisfied by higher prices. The likely result will be a revaluation of gold by multiples. Inept leaders, you can pick whichever side you want. Inept leaders and lack of statesmen, you can pick whichever side you want, are the typical prerequisite for these periods, and that's one of the falling dominoes. I have always argued that a country gets the leaders it deserves. Wait for AOC. That's going to be a real beauty. As we get to the end of one of the worst periods in history, both financially and morally, weak leadership exists in most major Western economies. So let's look at the motley crew of world leaders and their unpopularity. This was written 2 years ago. Political leaders will not only be thrown out at elections, but also before their time is up. Here's the leaders and their popularity. Here's the one that Donald Trump thought was hot from Italy. That's Japan, 57. France. I can't read. It's hard to read backwards. Is that Argentina? Let me look. No, that's Canada, 65%. The bald guy, I guess, is not that there's anything wrong with bald guys, is Germany, 70%. Joe Biden, breakfast at Biden's, is 59%. And this other fella looks like the UK is 72%. Just look at the picture above from the recent G7 meeting in Italy. With the exception of Italy's Meloni, the remaining G7 leaders have disapproval ratings of 57 to 72%. Oh, that's disapproval. She's got the lowest disapproval. That's because she's hot. Actually, she's tough. She's tough. With elections in the UK and France this year, the ruling parties are guaranteed to lose. And I think he was right with some of these guys. The French presidential election is not over until 2027, so Macron could be a lame duck for 3 more years. The French people are unlikely to accept that and might force him out before then. Whoever is elected in France, the powerful trade unions are likely to bring the country to a halt. UK's Sunak is one of Britain's most ineffective leaders in history. But the new Labour Prime Minister, Keir Starmer, was not even seen to stand a chance 2 to 3 years ago. He will not be voted in. He was, I think. But Sunak will be voted out by the people. Next will be a very dark period in United Kingdom history, with high taxes, high debt, poor leadership, political instability, and hard times. The US situation today is even worse, with a president who seems incapable of taking any decisions. One would argue that 26-year-old aides made the decisions. There was one young woman and one, I think they're about the same age, 26, 27, and one guy, and they ran the auto pen. I think the woman she's about 26, ran the auto pen. Instead, the United States is led by an unelected and unaccountable group of neocons who tell the president what to say and what to do. But even that is difficult for Biden to execute. Just his recent appearance in Italy at the G7 meeting confirms that 2 years ago. He can obviously not be blamed for being senile, but he should no longer have the ultimate power. The US election is likely to be a disaster. Looking at the poor health of Biden, it's unlikely he will stand for re-election in November. Kamala Harris will clearly not stand for election. It would not be surprising to see Hillary Clinton ushered in as the Democratic candidate. I would have thought that. Although Trump is loved by around half the people, he is hated by the other half, and thus a very decisive choice. And a rerun of the Clinton-Trump election could easily lead to trouble or insurgents in the United States, whoever wins. Germany's Schlotz campaign might not make it to the 25 election due to its unpopularity and the decline of the German economy. In summary, the political stage will be a total mess in the coming years, and lack of strong leadership will not only bring political unrest, but also social unrest. The currency domino has been falling ever since Nixon closed the gold window in 1971. As my economics professor said, he shut down the convertibility of the dollar into gold. He said, "Nix on that." With high spending and deficits on top of debt, to GDP being above 100% in many nations, the West in particular is facing a very dark period with galloping debt growth and collapsing currencies. This is why you own gold. This is why you own oil and gas. This is why you own whatever you know about, anything hard. This is why you get out of the choking debt like credit card debts. And this is why miners, but and I think AI. I think AI is I don't agree with everyone that AI is in a bubble. I think AI is the transformation that people are going to look back in history. They're going to wonder how we did anything. Anyway, so the West in particular is facing a dark period with galloping debt growth and collapsing currencies. This will lead to debt defaults, bank defaults, and more printing, higher interest rates, and still higher deficits. All currencies will accelerate their debasement process. Gold is an asset, everything else is credit. Silver is an asset, oil and gas, energy is an asset. Work is an asset, and I would argue that AI is going to take over a large part of the definition of work. But there's other work that's valuable. In such a scenario, there will be no winner. It is possible that the dollar, because of demand, will be slightly stronger than the other Western currencies, at least for a period. I think that's probably true. It'll be the cleanest dirty shirt. But a temporary relative strength of the dollar should be totally ignored. There is no prize for coming in second or third to the bottom. All currencies will lose dramatically in real terms, which means all currencies will lose dramatically against gold. And I'm going to have to convince as many of you that can adapt to this that your wealth over this next period of time, it might be 6 months, it might be 6 years, but over this next period of time, your wealth is going to be hard assets, your health and your knowledge, and your friendships and your family and your puppy dogs. And I'm less and less discomforted. I'm less and less discomforted by saying so, but also your relationship with the good Lord above. We must remember that we are now in the final collapse of the current monetary system. Since 1971, before most of you were born, all currencies have lost 97 to 99% of their value in real terms. Here's it's the mark, the yen, the Reichsmark, which obviously show me your papers, and the dollar, the D-mark, the euro, the pound. At the top of this chart, in a straight line, a constant at 100 is gold. So here's gold, the constant. All currencies since the 1900s, but certainly since the 1970s, have lost 99% of their value against gold. And you know what? They're going to lose another 95%. The final 1 to 3% fall from the 100, from that top line, but the final 1 to 3% fall, which will be 100% collapse from where we are now, will take place in the next 3 to 8 years. This was written 2 years ago. So yet another currency system will be laid to rest. The only way through this is to own gold, silver, hard assets, a farm, a mule, and miners, oil and gas royalty income, for example. And there's companies that are worth owning. And AI is a unit of energy and a unit of work, and it's a unit of productivity, in my judgment. I'm going to show you a report I did using AI, and I had to pay for it. But the agent, my agent, which I informed it, all my thinking and all that, my agent went out and talked to other agents. I put up $25, and my agent spent my $25 giving money to other agents to put this together. That's a real economic value, I think. So I think AI is also a place, but this currency system lasted since 1913, a little bit over a century. This currency system's demise was predestined before the day it was born. it was only a matter of time. As always in history, the consequences will be much more far-reaching than just the death of money. And he gives a picture. It's a painting by Bruegel, The Triumph of Death. We're so lucky we don't live back there, but I think what separates us from living like that, I hate to tell you, oil. Debt and currency collapses happen hand in hand. Debt and currency collapses occur at the same time. They are partners in crime and are the inevitable consequence of sustained government deficit spending. Gold is an asset, the rest is credit. After a period of unlimited currency printing, the financial system will fail totally. Political and social unrest also follows, possibly civil war. Governments under economic pressure normally start a war or escalate an existing one to divert the attention from domestic problems. A war is also a good excuse for printing more money. Then you have assets. That's another domino that falls. So obviously, this bit here at the beginning that's missing was talking about dominoes, because every headline is about dominoes. So the fall of the asset domino. We went through the currency domino, the debt domino. Now we're at the asset domino. Initially, there will be high inflation, possibly hyperinflation, and high interest rates. You don't believe it. Neither did the Germans. Thereafter, the system implodes. Inflated asset prices in stocks, that's what I'm saying is ahead. Bonds, property, etc., will crash by 50 to 100% in real terms. In other words, against gold. This has been a everything bubble, except for silver. But silver's about to catch up like a some bitch. Most sovereign bonds, if they are printed, will serve best as wallpaper. Most sovereign bonds, including the United States, will serve best as wallpaper. I think there's going to be one more rally in government bonds. So remember, his book is to get you to convince to buy gold, which I agree with. But nothing is always, anyway, black and white, but then it is. That's the thing. All of a sudden it is black and white. You want to build your position before everyone acts on it. And the thing about gold and silver, financial advisors in the United States and investors in the United States do not own gold and silver. If advisors started recommending even going to 1% in everybody's account, the prices would soar. Most sovereign bonds will serve best as wallpaper. I rate the chances of this chain of events taking place as very high, especially in the West. Financial, economic, political, and social collapses of this kind are nothing new. They have happened throughout history, albeit not on the scale of this coming magnitude. The fall of the nuclear war domino. Will we have a nuclear war? We obviously don't need to worry about this option, since if we have a global nuclear war, there will be very few, if any, people left on Earth. As the world potentially moves closer to such a war, we must ask ourselves, who is running the world? Good question. Well, no one individual, of course, but the U.S. leadership is probably the main contender when it comes to dictating at their whim to any country in the world. Well, until this recent, the emperor has no clothes action in the Middle East. Although if we pull back, I think we still retain our strength. If we get enmeshed in a nightmare, just remember we're on the side of the righteous. This can be, for U.S. leadership, can dictate to the world. This can be starting wars in a country which is no threat to the United States. This was written 2 years ago. This can be starting wars in a country which is no threat to the United States. This can be starting a war in a country which poses no threat to the United States. It can be controlling the global financial system through the dollar. Do you know the idiocy of Victoria Nuland under Biden? She caused, we can say it was Biden, but Biden doesn't know where breakfast is or dinner. She caused the United States to claim Russian assets, dollar assets, and alerted the world that you can't trust the dollar. I'm going to submit to you, and it's going to piss people off, but that's what you get when you get a feminized leadership. But I know that's one step too far, so please I apologize for it. That's Hillary Clinton up the wazoo. No, never thinking of consequences. But here's men, Anthony Blinken. God. So I guess it's men and women. So the United States can control the global financial system through the dollar, or by regulating the banking system via edicts like FATCA, requiring the world to report any dollar transaction to U.S. authorities. It also involves coups in countries which the United States leadership finds unacceptable, or even eliminating enemies. Bomb, 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 Iran. It can be sanctions or freezing assets against countries whose action the U.S. leadership disapproves. The list is endless. What is interesting is that the United States people never have a stay in any of these decisions. All the actions above and many more are taken by a U.S. president and his advisors with zero accountability to the people. None of that would be possible in a country, for example, like Switzerland, where people power rules through direct democracy. What the world should ask itself is, how does it solve the extremely serious situation the world is in? I'm not talking about the Ukrainian war, which, as Trump has indicated, could be stopped within a few days if the United States stops sending weapons and money to the Ukraine. So why are we doing that? I think it's on behalf of the banking system. They want Soviet assets. Putin recently made it clear that what Russia wants is to keep the Russian-speaking areas of eastern Ukraine and no NATO membership for Ukraine. But no one is interested in exploring this. Instead, there has just been a peace conference in Switzerland where neither Russia nor China were present. Such a conference is a total waste of time and money. Without two of the mightiest military and economic powers on earth, one of which, Russia, is directly involved in the war, this conference will achieve absolutely nothing. This is just posing for cameras with a bland, meaningless statement at the end. So instead of these useless conferences, the leaders of China, Russia, and the United States should get together to end the Ukrainian war and then tackle the real problems facing the world, like poverty, famine, crime, drugs, debt, etc., etc. Imagine what the combined brain power and resources of these countries could achieve, assisted by many more nations. But sadly, that dream is unlikely to be realized, of course. It's much easier to print money and start a war rather than find real and sustainable solutions to the major global problems. So world leaders have a choice. Pick up the phone and talk to your fellows leaders or start a war. What sane leader would choose nuclear war before a small loss of ego and peace? Well, don't know. All right, so now we get on to the reason for his missive: wealth preservation for financial survival. Wealth preservation for financial survival. And one thing I'm trying to indicate to you with Railtown is this is how to create wealth, relative wealth for you or for me. I was talking to somebody today. I have an embarrassingly small account. That's life. But this will create for me, if I can just accept my situation instead of remembering how I was, this will create, a modicum of wealth. Wealth preservation for financial survival. So what can investors do to protect themselves? I'll give you several do nots. And they're obvious, like do not keep most of your wealth in a fragile banking system, whether in cash or in financial securities. Do not keep most of your wealth in a fragile banking system, whether in cash or in securities. This is von Greiritz. With many banks likely to default, it might take too long before your assets are released, if they ever are released. Bail-ins and forced investments is if you have $100,000 at a bank, or if you have, $10 million at a securities firm and that firm fails, the government may come in and say, we're converting all of that into ownership of the brokerage firm or converting it into ownership of the bank. And you may take decades to ever see it. Bail-ins or forced investments are likely in government securities at low rates and for extended periods of 10 years or more. That's another thing that I expect to happen. I think IRAs, Roth accounts, 401ks, as the government needs to issue massive amounts of bonds, the government will turn its lonely eyes to America's retirement plans and say you're not allowed to invest in anything but U.S. government bonds. All right, so one do not hold most of your wealth in the fragile banking system, whether it's in cash or in securities. Second, do not hold sovereign bonds. Many governments will default. Do not bet on inflation reducing your debt. High interest rates or indexation of loans might make it impossible to repay borrowings. High interest rates and indexation. And I think some of that, particularly when it's in the mortgage area, will be forced upon you by the government and the banks. Remember, the banks own the government. Do not forget that stocks have been inflated by massive credit expansion, which will end. The value of stocks in the United States and worldwide have been inflated by a massive credit expansion, and this credit cycle will end. And we all have to be aware of that. The list of do nots in the biggest global debt and asset bubble in history is, of course, endless. But here's some do's. Howdy do. So some do's. Do hold a lot of physical gold and some physical silver in safe jurisdictions like Switzerland and possibly Singapore outside the banking system. Precious metals must be held in very safe, non-bank vaults in your name with direct assets to your metals. To minimize confiscation, or freezing of your metals, it is best to keep your metals outside your country of residence. Hold a meaningful amount of physical gold and physical silver. I don't have any. I can't believe, by the way, just to be personal, I lined all of this up for myself 15 years ago. And I don't know. You just can't get it all right. And then you got to start where you are. So I'm there with you. Most of our clients have more than 20% of their investment assets in gold. And then he says a much smaller amount in silver because it's volatile. Personally, I would flip that, but there's no question silver is volatile. Gold is up 10x this century in most currencies. That's this century, not last century, this century. Now, this is 2 years ago. The real move in gold and silver has not started yet. The move away from the dollar as global trading currency is likely to accelerate over the next few years. Well, it didn't help stealing Russian assets. Thank you, Victoria Nuland. I think she was the spearhead of that. And Hillary, of course. She lost an election, and it's Russia, Russia, Russia. It's one of the great missed opportunities in life. Putin, it wanted to work with us, and we're just gonna head our way. But also that what just happened, I don't think it's opinion, but I won't comment on it in case it is opinion. I think what we just stepped into over the last few weeks is going to accelerate the move away from the dollar. BRICS countries are, whenever possible, settling bilateral trading in their local currencies with gold as the ultimate settlement money. That's happening between China and Saudi Arabia now. This will be a gradual move away from the dollar. I think it will be gradual, but then it's all at once. At some point, the move will accelerate as the need for trading via another nation's currency will seem superfluous, especially since final settlement can be in gold. As I've made clear many times, the U.S. confiscation of Russian assets will lead to central banks no longer holding dollar reserves. Hillary Clinton, Victoria Nuland. Okay, you can throw Blinken in there, the little simpy wimp. Victoria Nuland has more balls than Blinken. The U.S. confiscation of Russian assets will lead to central banks no longer holding dollar reserves, but instead they will hold gold as the only acceptable reserve asset. Russia's added silver. The move by central banks to gold as a reserve asset will lead to a fundamental revaluation of gold over the next few years to a price which will be multiples of the current price. It's already started. The major increase in demand can only be satisfied by higher prices and not by more gold, since the world cannot produce more than the current 3,000 tons per annum. In my 55-year working life, I've experienced two major bull markets in gold. The first one was from 1971 to 1980, with gold up 25x from $35 to $850. The second one started in 2001 at $250 gold and has only started a move which will reach multiples of the current price. But my 55 years of gold history is just over 1% of the long-term bull market in gold. Since the emergence of the fiat money system, the gold bull market is more a reflection of government's mismanagement of the economy, leading to ever-growing deficits and debts. In such a system, the price of gold mainly reflects chronic debasement of paper money. Governments and central banks are gold's best friend. They have, without fail, always destroyed the value of fiat money by debasing the currency through deficit spending and debt creation. For example, in the Roman Empire, around 180 to 280 after death, Annus Domini, the denarius silver coin went from almost 100% silver content to zero, replacing silver with cheaper metals. And it wasn't too much longer that the soldiers stopped soldiering. This obviously leads to the question, why should anyone hold fiat or paper money? Well, in a sound economy with no deficits, virtually no inflation, and a balanced government budget, holding cash that yields an interest return is fine. But the world has not experienced such Shangri-La times since 1971, when Nixon closed the gold window. Still, and this is 2 years ago, at $2,300 today, gold in relation to money supply is as cheap as it was in 1970 when it was $35, or it's as cheap as it was in 2000 when the gold price was $300. Gold is up 10x this century. All right, that seems to be a repeat. So luckily I can skip it. That's it. That is Egon von Greiritz 2 years ago, and I read it to you then. I'm now going to throw that away. All right, let's get back to Railtown and see what's going on. One of those companies you guys mentioned to me yesterday, Codair, is in the AIP network. Did you know that? 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 All right, let me get, all right, I got to sign back in. I'll give you the prices, then I'll go to your comments. Sorry, I didn't mean to ignore them. All right, Railtown is in the green, but not by much. Finger is down. Let me get the litany here. Railtown's up 0.0025 at 31.58. I sure hope Will Underdown is acting. Act. Doubt later, act now. Finger is down 0.0374 at 98.26. Zigil is down 0.09 at 221. Xanadu is up 62.22 at $28.32. That stock went from around $4, $5, $6 to 42 and settled here at 28. My belief of what could happen for Railtown is you're going to have a jump in asset value once the aha moment goes on from 32 cents to maybe $7, $6, $7. But then you could have that same kind of move that Xanadu had. Nobody heard of Xanadu. And then HLP is up 0.0022 at 0.822. The Dow is down 252.4889, and the Nasdaq's barely green. S&P is barely red. And yeah. All right. So let's go with what you guys are saying. Before I start, I told you I'd show it to you one more time. I'm amazed at you guys. You are the best. Do you know where you are? You're 19,865,184 shares of Railtown. This is going to be our core. This is going to be what's going to allow us to create a massive life raft of about 250 souls and families to get through whatever comes ahead of us. And by the way, the planet, this is all of human making. The planet will go on with sun and birds and animals and water and fish. It's just a matter of getting through the human panic and getting to the other side as an independent actor, as your own central bank, so that you have viability and options. That's my goal. All right, let's see. CJ Yukon, congratulations, CJ Yukon. Pat M says, nice, CJ. And Keith, hi, William. I love that guy you're listening to. Oh, all right. Let me find out the name of him. This guy is WTF Finance Podcast. Here, we can listen a little bit, Keith. I'll show you. I don't want to show you. Gosh.
Welcome back, Edward Dowd. Most markets are fixated on the Iran conflict.
But the other guy's Edward Dowd.
My guest today argues that the real breakdown is already happening beneath the surface, and that war has simply accelerated a recession that was always coming. A housing market hitting its classic 18-year cycle, a private credit market acting as canary.
And this guy
in the
is
coal mine,
Anthony
and trying to slow down that view of
Fatsis. Anyway, I don't want to get a copyright strike. I'm sure these content creators don't mind me sharing to a new audience, but I'm not sure that's how YouTube sees it. Now that I think of it, it was NVIDIA that gave me the the copyright strike. Anyway, I just don't want to take a chance. But yeah, I listened to him, Keith. The younger guy is great, but the gentleman Dowd, I listened to him, but there's so much noise. There's so many opinions. You've got to pick one or two horses to run on, but you got to be aware of all the rest of them. And so anyway, I listened to him. The only disagreement I have with him is I think it's very near impossible to predict the top and to predict when it all pops. But there's no question that we're in a massive credit bubble. And, I've given you some of the triggers. One of the triggers will be high oil prices. The awareness on bond desks around the world that there's not enough cheap energy to provide growth to pay back debt. But we're not quite there yet. But yeah, Keith, I'm glad you listened. That says a lot about you, that you're seeking input from these intelligent people. CJ Yukon lowered my cost to 41. Excellent. That's a great price, 41. I know you don't feel like it right now, but it is a great price. Actually 31.46, close enough. Jack Hamilton, looking well. William, hope you're feeling well. Yeah, yeah, I am. I mean, it's a good day. Pat M, we are all for everyone doing good, no matter how much they own. Exactly. The way to look at it, it's kind of relative to your situation now. So one of the goals is to maintain. Another goal is to create wealth. And I had my margin call. I just can't imagine. It's not worth. I can't change it by thinking about it. But it was a spectacular. A spectacular decline in assets, but you just got to go forward. Jack Hamilton, well put at Pat M. I agree. Ricky Brogan, Pat M, 100%. Bob's your uncle. Hi everyone. Good going, CJ. Yukon. We are close, people. Giuseppe. Hello, William and everyone. Hello. Bob S. Well put, Pat. Joe Marty, I love it. Hey, Bill, grab 600 more. I love it. I love it. It'd be nice if my pen worked. I don't get it. It's a brand new pen. Nothing works anymore. Oh, well. I have plenty of pens. A man who hath plenty of peanuts and giveth his neighbor none shan't have any of my peanuts when his peanuts are gone. Bob S, nice, Joe Marty. Bob S, nice, Joe Marty. All right, so that's it. All right, let me see. I don't think I have anything that I wanted to show you here blocking the screen, but I might. Let me just look. Nope. I don't think so. It's okay. We'll go through. We'll go through some things. All right. I wanted to go yesterday. I don't know how. I didn't know how to frame it, but I wanted to show you that markets are not efficient. Markets can be spectacularly wrong, and they can be wrong for a long time. So while it's what I've got here is much more macro than micro, I did try to incorporate Railtown in it. And the basic thing I was seeking was, how is it possible for the market to be so wrong if I'm correct? Implicit in that question is, what if I'm wrong? Right? And so I came up with a report, which I didn't come up with the title: Efficient Markets, Inefficient Manias. And there's a number of intellects and Wall Street types, including Jeremy Grantham, who have spoken to it. So that's going to be in here. So it's going to be a little bit of an education on market inefficiency. This idea of efficient markets, I think the guy's name was Eugene Fama. You know, it's a very academic idea, but my opinion, it's just wrong. It might be true in the big stocks where all the institutions are, but I just think it's wrong. So, so it's called the efficient market hypothesis. The idea is that everything you need to know about the stock is reflected in its price. So if that's true, EMH, efficient market hypothesis, then Railtown is telling you by its price that essentially it's going out of business. Is that true? Well, the efficient market hypothesis is you don't really have to do any studying, just learn how to read charts maybe, but everything's in the price. So therefore, buy an index. Well, let's see what they all say. So EMH, the efficient market hypothesis, is a useful baseline. In its weakest form, which is that publicly available information is rapidly incorporated into stock prices. It is the strongest single working assumption an investor can hold. However, there are a lot of practitioners with documented track records who reject this EMH in hard form. Charlie Munger says Berkshire's record was achieved, quote, without paying 1 ounce of attention to the efficient market theory in its hard form, unquote. Seth Klarman, who I don't know who that is, Seth Klarman calls value investing, quote, predicated on the proposition that the efficient market hypothesis is frequently wrong, unquote. And Jeremy Grantham documents 300 plus 2 sigma bubbles and argues that all completed bubbles in major equity markets retrace to trend. And then they quote some other people I'm going to skip. I'm going to skip that. .com and 2008 are price stories layered on credit and incentive failures. The NASDAQ fell 77% from its March 2000 peak. It's not hard to add 20% to that. My target is 95%. That's the .com correction, was 77% in the NASDAQ from the peak. And it did not regain that price until 2015. Housing in 2006 displayed classical asset bubble behavior amplified by debt and misjudged default risk. So the point is, market prices didn't get it right. AI venture markets in 2025 show several Grantham-style bubble market markers. AI captured close to 50% of global venture funding in 25. The OECD reports 109 billion into AI infrastructure venture capital alone last year. Langchain raised 125 million at a $1.25 billion valuation on a $12 to $16 million ARR. I didn't even point that out. These are AI-linked concentration patterns flagged by Grantham. But it's hard to pick the exact top. The investor takeaway is humility and process, not market timing certainty. Treat the EMH as a strong prior on individual security selection. Treat Grantham, Klarman, and Munger as strong priors on category level extremes. Demand a margin of safety. I think we have a huge margin of safety in Railtown, especially where price to revenue multiples encode multi-decade growth assumptions. Railtown has no assumption in its stock price right now. All right, so anyway, that was the summary. What the efficient market hypothesis claims and what it does not. Eugene Fama's 1970 review defined an efficient market as one in which prices always fully reflect available information. That's all in quotes. The hypothesis was formalized in 3 versions, each of which is an empirical claim, not a theorem. The weak form, past prices and returns contain no profit-making signal. The empirical status, easy to test, broadly supported, though intermediate-term momentum is a notable challenge. Then there's the semi-strong form. All public information is rapidly impounded into stock prices. Empirical status, it is supported by event studies. The joint hypothesis problem complicates testing because any test of efficiency is also a test of the assumed pricing model. Okay, I get that. And then the strong form, all information, public and private, non-disclosed, is in the price. This is empirically rejected. And so that's interesting. The insider trading and selective disclosure cases consistently produce abnormal returns. While we don't have inside information on Railtown, I think we've put together a compelling story while no one else is looking. And part of the reason no one else is looking is those people that do know the story, who have material non-public information, can't buy. So Fama defended himself. In a 2024 interview, Fama clarifies what efficiency means in practice. For almost everybody, the market is efficient in the sense that they don't have information that's not already built into the prices. I mean, we don't, in general, if you brought a stock to us, we don't have any advantage. I think we do have an advantage in Railtown because of, and it's not just me, a guy like Ward Richardson has studied this space for 7 years and he knows it cold. and others. So I think we do have advantages here. I don't know that we can claim to have the advantage of an insider, but we do have the advantage of studying it, piecing together the trends, understanding the overall AI macro story. But we've really drilled down to what is this Railtown platform, and it's in the hottest space, at least in sovereign AI, but it might be robotics, it might be voice, all the applications that are real-time ingestion, Railtown's there. So I think we do have some advantages, and we're going to, because of that, we're going to see outsized returns. Anyway, FAMA maintains there are huge price swings, but they're basically unpredictable. Well, okay. I don't think that's true. And treats the word bubble as something you identify in hindsight, not something you identify going forward. I would amend his statement to say you can identify the end of a bubble in hindsight, but I think you can pretty clearly determine that prices are inflated. It's just you don't know that they won't get more inflated, and you don't know how long they'll be inflated. FAMA says event studies measuring abnormal returns around discrete corporate events are among the best evidence on how efficient the market is. They reliably show that average prices respond quickly and roughly correctly to new information. Well, we'll find out with Railtown, won't we? That information is missing, and I think that's our opportunity. All right, so the critique of this theory, and I consider myself in the I totally disagree with the efficient market hypothesis. I think there's segments that you can't create an opportunity. But so the critics are Grantham, Munger, and Klarman. Three practitioners with very different styles have reached overlapping conclusions about the efficient market hypothesis, EMH limits. None deny that markets are competitive on average. All argue that category level mispricings are common. That's what I say. Identifiable. That's what I say. And exploitable by patient capital. That's also what I say. We've had to be more patient than we wanted, but I think when we look back, a year's not too long to wait for what's about to transpire. So Jeremy Grantham, bubbles as measurable statistical events. At GMO, that's his fund. We have always, or his advisory firm, we have always defined a bubble as a two standard deviation divergence of the price of any asset class above its long-term real price trend. Markets very seldom even try to predict important change. In complete contrast, markets extrapolate today's conditions into the distant future. I think that's true. I think the markets, who are made up of people, reflect what's happening right now and maybe the most recent 2 or 3 quarters, the most recent year or so. And they say it's going to happen forever, like with Railtown. Well, the stock's down. Everybody's, it's red. It's going to keep being red. It's always going to be red. And that's just not true. I mean, I just showed you Xanadu, or talked about Xanadu. It popped up out of nowhere. And I think that's what Railtown will do. So the rule from history is that great technological innovation lead to great bubbles, from railways to electricity to radio to the internet. That's something we have to look out for. So Grantham operationalizes bubble statistically rather than rhetorically. His study of 300 plus so-called bubbles finds that in large developed equity markets, every completed 2 sigma bubble has eventually retraced to its prior trend, retraced to the mean. And he cited examples of US equities in 1929, 1972, 2000, the US housing market in 2006. And his co-author writes that in the current AI-driven episode, and this is something we got to watch out for, most investors will be nursing large losses. Especially with companies like OpenAI moving from 30 billion to 750 billion, Anthropic from 4 billion to 350 billion. We're not there. We're not even in that league. But we got to watch out for that. There'll come a time where we get so carried away with our beliefs and our stories. We got to remember it's just a piece of paper. And we may have to take actions, but I submit to you it's going to be at such much higher numbers. And the reason I get so urgent or so adamant, I just don't want you to get out at 2. There's, fantasy of fantasy, it goes to 200. Well, that's a different story, or maybe somewhere in between, it's a different story. So Charlie Munger, Berkshire's whole record has been achieved without paying 1 ounce of attention to the efficient market theory in hard form. It was always clear to me that the stock market could not be perfectly efficient. You'd have to believe in the tooth fairy to believe that you could easily outperform the market by 7 percentage points per annum just by investing in high volatility stocks. The idea of perfection in all market outcomes is going the way of the dodo. Munger's critique is 2-pronged. First, an empirical track record argument. Berkshire's compounded performance is inconsistent with the strong form EMH claim that no one can systemically identify mispricings in stocks. Secondly, a theoretical critique of the early CAPM EMH equation of risk with volatility. He treats the proposition that high beta stocks must earn equity risk premium size excess returns as obviously contradicted by the data. His position is compatible with weak form EMH, and he rejects the strong form. And then we get to Seth Klarman, value investor, and he's anti-EMH. Value investing is, in effect, predicated on the proposition that the efficient market hypothesis is frequently wrong. Of the 3 forms of the efficient market hypothesis, I believe that only the weak form is valid. The pricing of large capitalization stocks tends to be more efficient than that of small capitalization stocks, distressed bonds, and other less popular investment fare. By itself, risk does not create incremental return. Only price can accomplish that. Academics tend to create elegant theories that purport to explain the real world, but in fact oversimplify it. One such theory, the efficient market hypothesis, value investors have no time for these theories, and generally they ignore them. Carmen accepts the weak form, but rejects the strong and the semi-strong. He explicitly maps out where inefficiency is most exploitable: small caps, distressed debt, and less followed securities. His margin of safety principle is that the practical hedge against the joint reality that valuation is imprecise and that humans err. I think we have a huge margin of error in Railtown. It's priced as if it's going out of business. All right, I'm going to skip the summary. And I'm going to skip the defender case of EMH just to save time. And then there's some historical stress tests that showed the market was wrong. One was the dot-com bubble, 1995 to 2002. The NASDAQ composite peaked at 5,048 on March 10th of 2000. I put something like 90 grand to work right on that because a friend of mine called from London right then. I made all my money back despite the collapse by selling calls over time. What an experience. So it fell to 1,139 on October 4th, 2002, a 77% drawdown, and it did not regain its 2000 high until 2015. Many of the sharpest losers had fundamentals that were already inconsistent with their valuations at the peak. Negative free cash flow, high cash burn, and revenue models built around eyeballs and forward growth assumptions that priced in dominant terminal and endpoint market share. So it proves that aggregate prices can detach from fundamentals at the sector or theme level, and they can do so for long enough, years, that the run-up itself becomes a sociological event. What it does not prove that the bubble was identifiable as an actionable short in real time. Many sophisticated investors who shorted technology in 1998 and 1999 were forced to cover at large losses before the eventual crash. Mispricing can persist even when it's identified. That's one advantage that Will Underdown has. He didn't get in at 60 cents, 50 cents, 45 cents, 40 cents. He didn't get in a year ago, and he's not worn out. He's coming in if he does it. I hope he does. He's so fortunate. All right, the other example is that 2008 housing and credit crisis. MIT Sloan's post-crisis analysis concludes that the U.S. housing market displayed the hallmarks of a classical asset bubble, inflated over optimistic price expectations, which led banks to lend against rising collateral, underestimate default risk, and the banks absorb the resulting losses. Household expanded mortgage debt, securitization layered model risk on top of real estate risk, and there was a lot of mispricing. What it proves, asset bubbles financed with leverage propagate through the real economy. The combination of mispriced collateral plus high leverage creates systemic risk in a way that can that an equity only bubble would not. So in other words, without all that leverage, you don't get that systemic risk. Bankel concludes this point explicitly. The EMH framework can accommodate periodic mispricing while still recognizing that debt finance mispricing is uniquely dangerous. What it does not prove. I'm going to skip it. Then they have a whole chart with a bunch of quotes from Schiller and Schleifer and Greenwood and Schiller and Jagadish. So basically, all of them think it's hard to beat the market. Well, I agree with that. And I'm going to skip. I don't want to, it's too, I'm finding it too technical. All right, now we'll get to the part of it that relates to us. Implications, because this is the question I asked it. Implications for today's AI valuations and Lang chain style infrastructure. AI captured close to 50% of global venture funding last year, up from 34% the year before. Private markups include OpenAI from 30 billion to 750 billion and Anthropic from 4 billion to 350 billion. Crunchbase reports foundation model companies alone raised 80 billion, with OpenAI at a 500 billion valuation and Anthropic at 183. LangChain raised 125 million Series B at a 1.25 billion valuation in October of 25, led by IVP, with Capital IG and Sapphire as new investors, and Sequoia, Benchmark, and Amplify as existing backers. That values the company at roughly 6x the Series A valuation of 200 million at 18 months earlier, and 125x the original $10 million seed valuation in April of 2023. The company declined to disclose financials. Fortune reports ARR of 12 to 16 million and described by spokespeople as low. And Fortune notes the company is not profitable, but characterizes its spend as efficient. On those numbers, the implied price to ARR multiple is 78x to 104x. At the implied 78 to 104x, LangChain is priced for revenue acceleration and durable category dominance. That is a defensible bet, but it is not a bet that the efficient market hypothesis weak form of efficiency offers any protection. Klarman's dictum, quote, by itself, risk does not create incremental return, only price can, unquote, applies acutely. Run a reverse discounted cash flow, what ARR and margin path is required to justify 1.25 billion at the market discount rate. Yeah, we've done that. So then he talks about reflexivity. And then they talk about open source monetization. LangChain's core framework is open source. The commercial business depends on capturing value via Langsmith, hosted services, and enterprise contracts against competitors who can fork and reproduce most framework features. Pricing power must come from data, integrations, or distributions, none of which is obviously locked in for an early stage orchestration layer. Fair enough. So they ask underwriting questions relative to LangChain. What does a 5x return require? At 1.25 billion today, a 5x exit needs 6.25 billion enterprise value. At a 15x ARR multiple at exit, that requires roughly 400 million plus ARR, a 25 to 33x increase from today's 12 to $16 million base. I'm going to leave it there. They have some closing thoughts. So what I hope in a very probably boring way, that you see that thinkers and market participants find the idea that the price tells you everything can be wrong. It brings up some questions about LangChain and its valuation. And I didn't think of it until I read that last bit. Railtown is in a much better position than LangChain, much better position. LangChain has this orchestration framework, and their backers are forcing on it what it can do. And I'm not sure it can do everything that the backers want it to do yet. They have plenty of money to create it. But what Railtown has is a soup to nuts platform that has already been built. Conductor was a 2-year heavy lift. Rail Engine was a 2-year heavy lift, maybe longer. And the integration has already happened for free. The gentleman the other day says we're light on revenue. Well, their model was to give a lot of it away for free for a long time. Why? Because the AI is self-learning. And so when Corey calls it battle tested, it was battle tested on these clients. And yeah, the revenue doesn't show up, but that, short-term pain for long-term gain. And reading that, I think there's some risk in LangChain. Because when Railtown comes out, it's very plausible that Railtown is a better solution, as I've argued all along. All right, so that was one thing I wanted to go through. Let me tell you where the price is closed. Damn it, I have to sign back in. I did it. It just always signs me out. Okay. Railtown closed 31.93. Fingers down. Well, it's trading now. It's flat. 98.98. ZJYL down, I guess, after the market. It's at 204. Xanadu 27.90. Help is 81.81. and the market's mixed. All right, let me go through some of your comments. Pat M, thank God, goodness that Powell's gone soon. I don't know. You're probably right, Pat. You're probably right that it's better to have him gone. And easing interest rates might be a medicine we need. So, and also I think Powell just dislikes Trump, and people have their opinions, but when it interferes with working for the economy instead of working on your personal agenda, I think that's bad. So yeah, you're probably right. Ricky Brogan, spiked below the 20-day moving average. I'll show you something. I actually think a friend of mine pointed out that the stock might be vulnerable to going a little bit lower, which in my own defense, I pointed out to you at the end of last week that I thought the chart looked like it was going to go sideways to down for a few days. I call your attention, Ricky, to the fact that the heaviness, when we call it short sellers, everyone laughs at us. I don't know if heaviness is a better name, but I hope it includes a broader co-conspiracy than just, this valued short seller that cleanses the market. Today, here it is. Here's my calendar. I think tomorrow's the last day of the month. Yeah, tomorrow's the last day of the month. So I would imagine that Railtown will be under pressure tomorrow. Why? Because the heaviness, the shorts, they want to print the end of the month number to show their masters that they're making money, that the money they're borrowing to do it is justified, and then show their clients that they're doing well. So I would imagine, but I'll show you a chart that my friend did. It shows that he thinks it's going to go down, which I'll show it to you. I don't try to cherry pick information. Keith, I've never said previously, so please add to your list 145,000 shares. I want to be the guy. All right, Keith. That's exciting. You are the one that's going to put us over. Thank you. $145,000. Thank you. Tomorrow's update will be because of Keith. I hope that Will Underwood is making the shift. Keith says, been buying for over a year now, maybe longer. Bravo, bravo. That's a great way to do it. Bob says, excellent. Excellent, Keith. Keith says, thanks, Bob. Ward Richardson says, I see the share count is at 20 million one. I see the share count at 20,018,784. Yay. Ward Richardson, Pat M., I agree with you on Powell. May 15th will be his last day. Clap, 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 clap. Ward Richardson, William, when RT hits the streets, LangChain will shrivel away. That's what I just took from that. I don't think LangChain has a soup to nuts solution. They also, what Railtown has that LangChain doesn't have, just listen to what this said. Just listen to this one sentence. There's all the sources, by the way. But just listen to what this sentence said. I got to find it. LangChain's core framework is open source. I don't know if that's good or bad. The argument is that it's good because it grows more quickly. But Railtown is open source on some of it. But one of Railtown's strengths is its vertical concentration, which allows companies and countries to presume that their data is safe. The commercial business depends. LangChain's commercial business depends on capturing value via Langsmith, hosted services, and enterprise contracts. Well, do you hear that? Fair enough, but this is against competitors who can reproduce most of the features, and they got the money to do so. But it's enterprise contracts and hosted services. The way I read it, it's one-off, 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 one-off. Maybe big, but it's one-off, one-off. And they do have apparently a third of the Fortune 500. But what does that mean? That means developers who service the Fortune 500 through their companies use LangChain. But developers are starting to use Railtown, as we see in the hackathons, and developers will pick and choose what works. People used to use Yahoo search before Google. People used to use MySpace before Facebook. Other examples like that. And I think the great advantage that Railtown has, they have rail engine, conductor, and rail tracks, soup to nuts. And it's powerful. They don't have to put any more money in it. It's going to scale. They're not raising money to create the product and make the product do what the promoters of LangChain are saying LangChain's product can do, the fake it till you make it strategy. And hell, with $100 million, you can get a lot done. But Railtown's already done it. I think better. They have the IP. And I think LangChain is clunky. You create these chains of data and you link them together, and it's supposed to do something. Railtown is right on top of the data center, but the three prongs to their platform all work together. And they can read every single language out there. You don't have to learn anything new. So if you're a developer, you can plug in, and if your language is Python, I don't know what Python is, or if your language is something else, you can use it. Railtown's set up to process all 33 major software languages. And if anything else goes, they'll add that. So I think Ward's correct that once Railtown hits the ground running, I think it's going to sprint to the lead. But the other advantage that other than having this soup to nuts platform and being robust and being able to scale and not needing any more development, by the way, although there'll always be that, is Railtown's not going one off, one off, one off, one off. They're going to the top of the first and only operating sovereign AI data center / factory in Canada, which, by the way, is in the top 100 of data centers in the world. And as soon as that, whatever TELUS does to turn on the switch, I don't know what subset of that is going to move to Rimouski Data Center. But if it's 10%, that's your $2 billion. And Railtown's right there. So that's our thesis. And once that proof of concept comes in, you're proving it to hundreds, thousands, tens of thousands of companies all at once. And that AIP network is big, 200 AI companies that then have 5, 6, 7,000 end users, or it will grow to that much. But the big thing is if Railtown proves on top, their customer is one massive center of influence that brings customers to Railtown, and Railtown doesn't have to lift a finger. If it proves, they go do it at, I don't know. There's 2 other telecoms in Canada. It's at least logical they go to Rogers Communications and they go to Bell Canada, as long as they're staying neutral. Who knows? But they come into the United States maybe. Or maybe they go to Germany or Poland or the UK or France. They go to Korea, Japan, Indonesia, Singapore. What about Singapore? Railtown's customer is these huge aggregators of a giant pool of customers, and their next customer will be another aggregator and another aggregator and another aggregator. I mean, it's just huge. Ricky Brogan, Keith, congratulations. Yes. I'm kind of excited to find out. I think Joe Marty's 600 might have done it. Might have done it. All right, what else to go through? I wanted to remind you that tomorrow Corey gives he's the moderator of a discussion on, I think I have that here. Let me show it to you. I may not, but I think I do. So at 3:30 p.m. to 4:30 p.m. tomorrow, Corey Brandolini will be moderating a panel discussing AI sovereignty and scale. And I assure you, Railtown can scale. Canada's next innovation challenge. Canada is at a turning point. We have the research, but do we have the power to scale? The session explores how Canada can move from a research powerhouse to a global commercial leader by serving the entire AI stack. from the necessity of domestic compute infrastructure to the strategic capital required to keep intellectual property on home soil, our panel will discuss what it takes to build, scale, and own the future of AI in an increasingly competitive global landscape, and will make the United States our 11th province. How many provinces do they have? 9? I used to know. How many Canadian provinces? Ten. And 3 territories. Well, so I was close. So they'll make the United States their 4th territory once they're big. Do you want to know what they are? British Columbia, Alberta, Saskatchewan, Manitoba, Ontario, Quebec, New Brunswick, Nova Scotia, Prince Edward Island, Newfoundland, and Labrador. And the 3 territories are Yukon, Northwest Territories, and Nunavut. All right, so I don't think I have much more to talk about with Railtown unless you have questions. Oh, I wanted to show you. Yeah, I wanted to show you this chart. Let me show it to you. I don't agree with this guy, but I'll show you what he thinks, and it's not bad. It's not bad. I don't completely agree with him. But it's a different chart service than the one I usually use. So here's the chart, and this is what he said to me. And he's a very good chartist for what I do. He said Railtown failed the trend line, and that is clear here. That is clear. It failed the Ricky trend line. But it didn't fail this support per se. And what this gentleman's calling for, he says he thinks it's headed back to 27 cents, a double bottom. I would imagine, if he's correct, that it won't be so much that it comes down at a double bottom. It'll be more of a ascending bottom. So it might tomorrow get to 29.30, and it might go sideways a bit or turn around a bit the next few days, which is something I suggested to you. I thought it would happen because it looked like it had broken the Ricky support. But I don't think this is going to go on very much. And the best news of this chart is this red line is resistance. If we bust through that, I think it'll bust through. It'll come back to test it. But this is 1, 2, 3. The next time is 4. And if we go through it, it should be sustainable. It'll pull back at some point to test it, but that should be it. So that, to me, that's very positive, but I'm bullish. We'll see what happens. All right, it's 4:24. I might quit a bit early. On the other hand, I want to talk about 2 things unrelated to Railtown briefly. One is about the gold company many of you invested in. And I'm going through my file, and um, and I'm not sure. I have I'm not sure how much new information I have in it, but I'll just quickly go through the report without showing it to you. I've done it before as a way of making you excited about what you're in. We raised in this little LLC that I set up because they wouldn't take money um, unless it was through me and my um, my arrangements. Um, we raised about 75,000, so that was in the middle of what I wanted. Mini 50, maxi 100. I was hoping to go over 100, but we hit right in the middle, and I think that's great. I'm going to be traveling in 2 weeks, or a week and a half, to try to lock down that bigger picture. I'm not going to preclude the gentleman who I consider a friend, but I haven't spoken to him in a little while here, which happens. But I am trying to work to go and move this project forward with the help of investors. The risk is that a opportunistic offer comes in to take over the whole company and caps us at a 10 or 20x return. I think that sucks because the upside on Railtown, on this company, it's a little like Railtown. It's an on-off switch. But I just want to go over the lease is 4,200 acres, and it's mineral rights, which is the best. They've had the acreage, they had more, but they've had it since 2007. There was the earthquake, and there was damage to the lab. And then we went through that thing I can't talk about on YouTube, but we went through that period of time where everything was shut down. But the company discovered 6.6 million ounces of gold in these sands, felsic sands, during 2009 and 2010. They also drilled 37 200-foot sonic drill holes, 37. They went down to 200 feet. So the resource was determined to be 174 million tons at 0.038 ounces of gold recovered using caustic fusion assay, 0.038. And then that was confirmed in a separate testing, 24-ton bulk leach test using sodium thiosulfate, and that actually yielded more, 0.048 ounces per ton. in 4 separate leaches. Now, what's exciting to me doesn't mean, we still have to execute still, but what's exciting to me is the gentleman that's the prime mover, he's older now, tells me it's going to work. It's done. Now, don't take that as gospel, because you still have to go through it. That's what we need to raise the money for and produce. But anyway, there's two proprietary processes that both get 0.20 ounces recovered. 0.20. So that's a 5-fold increase in recovery. So that takes the 6.6 million ounces to 33 million ounces just on that drilling down to 200 feet. And it's not the whole, the 2 prospects they drilled is not the whole 4,200 acres. It was all chain of custody. And here's the color version of what I've showed you before. These are the gold bars they got out. So anyway, I think it's all going to start moving very quickly. And I'm going to do my best to swing into action to raise the $5 million needed to build out the plant and make this a success for everybody. If this other group wins, I think our we have all the risk, but our upside might be capped at 10x. So I don't want that to happen. We don't know what the proposal is going to be, but it will be capped. And it might be 20x, but it's still, that's not why you're there. It's not why I'm there. I just showed you the 6.6 million ounces third party at 0.038 in the 200 feet. If these 2 processes, I'm told they work, it's going to work. Everything's going to be great. Well, we got to verify that. That becomes 33 million ounces of gold. Well, 33 million at 5,000 ounces net, because the cost isn't very much per ounce. So if gold goes to 5,500, that should cover it. At 5,000, that gives 165 million in profit or revenue over time. And I don't know what the discounting would be. You get a JV partner, you sell it, or you try to do it yourselves. But that, if it goes from there to there, it's $165 billion. Well, just use $1 billion, a billion shares outstanding. It's $165 over time. I would hate to lose this to an opportunistic grab by a well-funded funder, private equity group. I hope that I am able to provide an alternative for all shareholders. Now, I just want to show one last thing. I want to show two things. On the 66, 6,600,000, if we take a lower net, let's just say 3,000 per ounce, because I don't know the cost. That's 20 billion. That's $20 a share. And it'd take a lot less time to process that. But I want to show you one other thing. If they drilled 2 wells down to 400 feet, just in the 2 sections, the north and the south, there's room in between and there's room on the sides, massive compared to what they drilled. But ignore all that. Just go down to 400 feet. And in each section, they drilled 1 well down that far just to see. And it was the same as is expected. It probably goes down 800 feet. And then you've got a section of, what do you call it? It ultimately goes down probably to water, seawater, but that in-between part has a name where there's water, and it's not called leach. It's called my brain. I can't remember. I'll remember it. But they went down to 400 feet. It was the same. So if we take 33 and we double it potentially, well, we could do that, but let's just do it here. That's 66 million. If you take this number and double it, you know, it's over $300 a share. So I'm trying to capture this for us, and I'm going to get to work on it. I am working on it. So I wanted to tell you that. And one of you sent to me, is the company going to update? Please, it's not the company, it's me. I have to update you, but it's a work in process right now. Everything that you sent has been sent to the company, all of it. So it's all transparent. I mean, maybe not yet because I haven't provided anything, but it's all in an arm's length bank account. And I'm still learning their processes. It's actually they set at PNC, they set up 2 accounts. So far, we haven't had money come in from the project, but the idea would be eventually we would have 1 account for any expenses or distributions and the other account to receive profits or payouts, so that it's easy to have an auditor go through. But I have an auditor in mind. I haven't hired them yet because I wanted to send all 100% of the money that came in. Anyway, I wanted to talk about that. I'm going to set up another LLC, a small one, for that company that I told you about, Ubatera. I've been given an opportunity to raise a little bit of money. I think 250,000. I have to check with the guy. But I'm really excited about that. Let me see if I can find their website. And this is it. They call it Zone View. But here's what they do. Zone View is a pure cloud and browser-based drilling, geosteering, and completion software that automatically leverages, layers, and visualizes all data in real time, AI. And it's unlimited. They have an annual fee, and it scales to each company's size. PDC Energy uses it. Zone View will transform your organization with a geology-led system which improves communication and collaboration between every department. Better, easier, communication between drilling, geology, and completions, stay ahead of drilling and geosteering hazards with alerts, prevent completion stage failures with zone view frac, perform asset-wide comparisons with their centralized cloud database, easily merge newly acquired assets into your existing databases, share live geosteering interpretations quickly with less effort. And then you share the data real time anywhere anybody is. A large Midland basin operator uses it. They won't give their name. They automate the tasks that a computer should do, letting you do the high value thinking. Anyway, I'll go through it. They reduce sliding in and out of the zone. You drill down and then you drill horizontally to stay in the sweet spot. Instead of cowboying it, it reduces the sliding in and out of zone while you're drilling with the real-time data. And it has more. I'm going to not bore you with. Let's see if they have anything else here I can read to you. Testimonials. Let's go with testimonials. Green Lake Energy Ventures. Zone view implementation is unparalleled. And I love Ubiterra's pricing model. They don't nickel and dime you for every user and feature. The 3D seismic data integration is incredibly useful and unmatched on functionality. Users can load entire volumes. That's what he said. Greg Durande from PDC Energy. We now have feedback through our teams that has allowed us to make material changes to our completion designs and has assisted in reduction of stage failures because we understand the rock better. Wasatch Energy. What I love most about ZoneView is that it isn't just a geosteering software. It's a tool for enhanced communication. It goes about the live project sharing in a more direct way than other software without additional cost. Julie Tanhill, completions engineer at Confluence Resources. ZoneView brings all the data back to geology in a way that no other software does. Red Stevens at Hibernia Resources. ZoneView's initial setup is important and saves you time in the long run. I've loaded type logs across our assets with our tops and standard strat columns. It's nicely organized. You just create your interpretation and it's pretty much all set up for you. Instead of working on standalone projects where you pull in type logs every time. Barrett Laverne, President, Trifecta GEO. ZoneView's geostirring capabilities helped us achieve our goal of being more than 95% in the zone, an improvement of 2x of any prior attempt in the surrounding area. We use ZoneView because it drastically improves our team's collaboration during operations. We also like its built-in analysis and visualization tools, which are used in post-drilling and during completions. A large Midland Basin operator. ZoneView's RigStream is my favorite implementation in any geostirring software. Anyway, I think I already read you Wasatch. Stephen Phillips at Wasatch. We are just that more nimble as a company with ZoneView. We can evaluate targeting scenarios super fast as we drill, and it's given us the ability to adjust early if we see we're getting out of zone. Ryan Hoff, geologist, DJ Basin operator. Being able to see everything together live in 3D allows you to tie the whole picture together, and where time is of the essence with faulting, ZoneView can save you time and prevent downtime. That's money. President of Premier Remote Geosteering at 2 a.m. when an emergency is occurring. Zone view is already up to date. In other programs, you're unpacking zip files or loading data that's already out of date. Geology team trailing zone view in the Marcellus. We've had problems with Witsmill in the past, but RigStream zone views automatic integration and visualization solution is flawless. DJ and Delaware Basin operator geology. It helps a lot that our completions team has access to zone view. They get information they need themselves. Our department can get really busy and we may not always have time to backtrack and compile the info for them. But that info is in zone view and it's at our fingertips. An Appalachian Basin operator. In side-by-side geosteering software tests, there was no contest. Zone view kept us from drilling out of zone. You get better, cleaner rig data and combined live steam data volumes. Trip TRP Energy. With zone view, you have everything you need in one place. You plan your well bore, and our live seismic during drilling has given us greater structural context for predicting the lithology ahead of the well bore. Another guy, Zone View is Dylan Miner approved, and he needs no introduction. Green Lake Energy, more, Greg, PDC. So you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 companies happy with Ubiterra and willing to say it. So the whole idea behind it is similar to what I thought Railtown was in the beginning. They're going to prove up that this works, and then a Halliburton or a Schlumberger or a KKR or maybe an Exxon or somebody else will buy them out. I think it'll be 5x, 10x when it comes out. Don't know. They might sell earlier. I think it'll be fairly soon. And the reason I'm bringing it up, I'm going to set up an LLC. I don't think I can raise more than $250,000. I'll try to put money in. I don't know the time frame, but as a standalone, alongside our golden venture, I think this gives us the money back on both, plus a lot. And this is a private placement that you'll never have access to, which I can offer. I'm not going to charge anything up front. I'll do it on the same split as the other one. And you have my email. Let me know. So anyway, let's go on with other comments. Ward Richardson, William, clunky is a good fit for Lang Chain. Clunky. Ward Richardson, William, I also think TELUS will buy out Rogers at some point. Now that's interesting. That makes much more sense than anything out there, because you've got this Merrill Lynch guy coming in. They have cash flow. Rogers is a cash flowing deal, but they're going to want to compete against you. I think that makes a lot of sense. Steve, the unknown stuntsman, hi Uncle Bill and RT people. Hola. Gargle the marbles. What do you make of the Mag 7 earnings, and how does that stand as a barometer for Railtown? Well, I look, I don't think we should be watching short-term things like that. I haven't watched all the earnings. I just saw that I think one of them just came out and beat expectations. But I think earnings are mostly manipulated to beat expectations. I find it, it's like a verification, But I think it's always manipulated. So it's much more how the market reacts. That's when I learned something. But let me see what the earnings are. Yahoo Finance. See if any Alphabet stock beats on cloud growth. So the Google parent is up. Meta stock falls on AI spending despite earnings beat. I think Facebook is the weakest out there. They have huge cash flow, Facebook, and they have a lot of loyalty. But I personally think that in an age of AI, somebody can come up with a competitor using AI, and Facebook may or may not be the monopoly they think they are. But I don't know. I don't know. Only you can judge that. But I think the problem with Meta is they spent $70 billion on the metaverse. They changed their name to Meta, and it was a big failure. So I'm not sure the street trusts their AI spending. But I will tell you, it doesn't matter. You're saying earnings and how the stock price is trading in the short run. They're going to spend the money. Google's going to spend the money. Meta's going to spend the money. And then Microsoft tops estimates and says their AI business is up at 123% over year. Railtown is embedded in every channel of Microsoft. 3 of them. I don't know if that's every, I guess, but they're in 3 of them, and they're going to spend the money. So regardless of what these stock prices do, Alphabet, Meta, and Microsoft are going to spend the money. And I think if you're spending hundreds of billions of dollars building out a whole new industry, you've got the chips, which if you only buy the chip, it's a lump of silicon. You have the chips. You have the HPE, whatever that does. But again, if that's all you have a nice museum piece. You have the data center, but you have to design it to handle the volume of in and out. And in Canada's case, they're creating hydropower, so it's green, and it comes in costing somewhere around 40% of competing electricity. 40%. It's over 50% cheaper. So if you're building that stack and you've set up a data center that's using NVIDIA's best product, and you've installed it to run more inexpensively than the competitors, the only other things you need are these. There's a couple of other companies like FireIX and that they own, TELUS owns, and a couple of other things, but you need a large language model. So we don't know who that is. Is it Anthropic? Is it OpenAI? Is it Cohere? I don't know. But they need that. So they're sorting that. Or they already have it sorted. We don't know. But the next thing you need is Railtown. And in announcements, in press releases, in presentations, in interviews, it is clear that Railtown is the chosen orchestration framework, which doesn't describe everything they do. The software engineering framework that's on top of the TELUS stack. So in order to make the 10, 20, 30, 50, $100 billion in spendings turn into revenue, you need Railtown. Or you need somebody else to come up with as good a product as Railtown's. Now, that's what's yet to be proven. But Railtown was first. They have the IP, and their platform, I want to say it's ready to go, but we learned that Rail Engine was completed in January. Then we learned it was completed in February. I wouldn't be surprised if we learn it was completed in March. We don't know. Sorry, in April. No, March. We heard January, February. Yeah, in March. So we don't know for sure that it's 100% all integrated and ready to go, but it's on the verge of being so. And then it's installed. And my answer to you is, if Teles's stack proves that rail engine, rail tracks, and conductor are the best on the beat, and that performance trends into visible, expanding, growing, predictable, high margin revenue for Teles, I don't think there's going to be a hyperscaler in the world that isn't going to say, son of a bleep, we've got to get that on top of our data center, because we're spending, Meta's going to spend more than they spend on Meta. They're going to want to make sure it works. And I don't think what earnings for one quarter does has anything to do with that spending, or with the need to transfer that spending into a product that, when it metaphorically, when a software engineering team takes it out of the box, they go, oh my gosh, this is perfect. All right. I guess for some reason, my power isn't working. So I think I'm going to take that time with the beep and the alarm, and to say good night to everybody. It's almost 5 o'clock. I'm going to try to make some calls tonight to work on the agenda I told you, and we'll follow up tomorrow. Thanks for tuning in. I think we're on the verge of something big, meaningful, and exciting, and I appreciate everybody here. And thank you to Keith and CJ and Joe Marty. I think the three of you put us over 20 million today. Peace, love, happiness, and we'll catch you on the flip side.